want to bring on our guest and get his thoughts about what's going on here. The biggest trading venue for ETFs, you know, it's right here under our roof. It's the NYSE and NYSE ARCA. Doug Yones is the man in charge of the NYSE's ETF business. He joins us now, and you watch this stuff like a hawk. Chime in on this. We're continuing to see astonishing inflows into bond ETFs in general, still inflows into equity ETFs, but not as big at this point. Do you see this continuing into the second half of the year?
It's been a great year at the start, and we're talking about some of those numbers, almost record numbers, but the fixed income story is just in the earliest of early stages. As Dave was saying, right, it's across the board. We've got over $83 billion coming into these funds, and it's not at a loss somewhere else. It's not as if we're seeing equity funds sell off and money flow into fixed income. Instead, you're just seeing adopters of the ETF strategy, the ETF wrapper. They want the liquidity, they want the ease of use, they want the diversification, and instead of choosing a mutual fund, they're coming to the exchanges and they're buying the ETF.
So we've got what now, $4 trillion essentially in ETFs?
Roughly $4 trillion now, that's right.
We still got 2,000 ETFs out there. I'm not going to ask the man in charge of ETFs whether we have too many ETFs. The fact is they're opening and closing a lot of them.
You'll know the answer. You'll know the answer from me, right? Which is there's still a lot of opportunity out there, and we are seeing it, right? We're seeing people come to the industry and say, is there a new way to slice this up? And I look at something like real estate. Historically, it was just a broad-based REIT strategy, let's say. Now, all of a sudden, you have issuers coming in saying, well, what if I just look at the places that host data, server farms, right? And now you have an ETF that focuses on cloud storage. So there are really unique ways to slice and dice the market, and it's happening in the world of ETFs.
And I love watching ESG kind of grow up, environmental, social, and governance. We all used to roll our eyes about this, saying, heavens, come on. I mean, everyone talks about it. We're all supposed to be environmentally, social, governance responsible, and yet where's the money?
Performance issues.
Well, that's right. Where is the money? Because the performance hasn't necessarily been there, and yet we've talked about this, Doug. The interest is growing.
The interest is growing, and the money's finally following, right? It used to be, well, let's all talk the nice talk, but let's not actually invest there, and that story's changed a lot. The two biggest launches in probably the last 10 years have been in the ESG space this year. And so the money's starting to finally flow in, the growth is there, the numbers are there, and it may have been a change in investor dynamic, or it may have been that the products themselves just weren't the right products, and now we're building the right things.
But Kevin, I understand your cynicism about this. I feel the same way. If everyone loves this so much, where is the interest or where's the money flows, and where's the outperformance?
I think the biggest
we haven't seen it although Doug mentions there is interest starting to grow.
Yeah, there is. But imagine if you're a fiduciary for a teacher in a pension plan, and you keep them out of munitions and tobacco, and you're trailing the long-term index by 250 basis points because you're not in these sectors. Tobacco produces a lot of dividends and return of capital to people. And my attitude is, if you're stupid enough to smoke, shouldn't I profit from you? Yes. I wouldn't smoke. You'd have to be an idiot to do that.
Yeah,
but if you're taking away performance from me because you as a manager have a personal feeling about tobacco, I bet you end up in litigation one day. That's what I think. So this whole issue about performance and what is a feel-good stock, what about sugar? What about sodium? What about food and all the stuff around meat, non-meat? Where does all this fit into an index that you can actually understand what you own at any one time?
Well, you've had to face this. Is a pension fund really in trouble for ignoring or excluding companies that wouldn't fit into a proper ESG screen?
Well, I think some of that conversation in some ways is the old conversation. What I mean by that is the new ETFs that are coming to market, they're actually going in and they're sector neutralizing. They're going in and they're saying, hey, here's a sector of exposure. I'm not going to hold those companies for various reasons, personal reasons or just larger persona reasons, but I can neutralize the sector exposure and actually bring back some of those returns.
I want to just, another quick subject. We've been waiting for a little more news about trading ETFs here on the floor of the New York Stock Exchange. We don't have it yet, but we're moving in that direction. Can you give us an update?
It's exciting times. For those of us that have watched this industry for a long time, it's a bit of coming home. The original ETFs, they were actually listed on a floor, but at the American Stock Exchange. And the New York Stock Exchange is now preparing. We're hoping to start to roll out this program within the next couple of months, where we'll actually bring ETFs back down to the floor where you have the designated market maker that can add the human component to trading ETFs.
Will there be more liquidity? Will be even tighter spreads? What do you think will be accomplished by doing this?
We're going to bring the power of the floor, the magnitude of that designated market maker, the person that's responsible to be there to add liquidity, but also reduce volatility. We've offered this to the greatest companies in the world for over 227 years. It's time to offer that back to the ETF industry.
10 seconds, I need a quick answer. There's a move towards non-transparent ETFs. We had Pisani active shares down here. Where is your thoughts on this? Where does the NYSE fit in with that?
It's a watershed moment for the whole ETF industry. There's something like $17 trillion in actively managed funds that have not been able to access the ETF market unless the star manager is willing to show everything in the portfolio. This will give them a chance to enter.
You think that'll expand the ETF pie considerably?
Dramatically.
Okay, we'll keep an eye on that and let us know about trading on the floor. Love hearing about that.